Welcome to the Bullington Capital Report, hosted by Bill Bullington. For the next hour, you'll receive information on current market conditions and trends that could affect your financial future. If you have a question for Bill, you can participate in today's program by calling 216-901-0945. That's 216-901-0WHK. You can also reach Bill by going to his website, bullingtoncapital.com. So without any additional delay, here's the host of today's program, Bill Bullington.
Well, welcome to the show. This is Bill Bullington. I'm your host here every Saturday morning from 11 to noon on 1420 WHK. And just trying to get the technical issues worked out here. Hopefully, there we go. I can hear myself now. Anyway, welcome to the show. We're going to be talking about a lot of different things today. Feel free to call in if you have any questions. I thought I would start by answering a question that was sent to me over the internet. And by the way, if you have a question, comment, you can always email me, bill@bullingtoncapital.com, or just go to my website, bullingtoncapital.com. And I thought this was interesting. It has a lot to do with a lot of the stuff that we've been working on over the past couple of months here at Bullington Capital. Department of Labor regulations, you might have heard me talk about that, have come out. They haven't really passed yet. They're expected to pass, and it's going to require that we do things a little bit differently. Not a huge change, a lot of paperwork. That's a lot. But one of the things that came up was they wanted to include commodities in real estate as separate asset classes. And this is depending on who you talk to, by the way. That's another thing that's kind of driven us a little nuts about this, is the interpretation of the rules, because the final rule hasn't been passed yet. And not only has the final rule not been passed, but there are so many interpretations of the way it's going to be passed. Even though we don't know what the actual law is going to say yet, it's been a little confusing. But some of the things that have been bannered around are that you're going to probably have to include commodities, and you're going to have to include real estate, which is kind of interesting, because real estate, they actually broke out in the major indexes as a sector all by itself. They started to separate that out a little over a year ago. So kind of interesting. Anyway, so one of the callers, or listeners, wrote in and said, hey, why don't you talk about commodities? And we can talk about commodities. It's a very difficult thing to invest in. In fact, the commodities, when you're looking at the historical return on commodities, it has no expenses built into it. So when you're looking at the Ibbotson, if you know what that is, if you don't worry about it. It's not a big deal. But if you're looking at the track record of commodities over the past 40, 50, 100 years or so, there's no way of factoring in all the expenses, or none of them have factored in much in the way of expenses. And that's where this thing really tends to go south, is that the investment products that you have to represent those commodities are carrying a lot of expenses with them that aren't being calculated in the calculation of the index. So why is that a problem? Well, it's a problem because you're going to be thinking that you're going to get X return, and it's not going to be X minus the expenses, and the expenses in those are enormous. There's a tremendous amount of expense in investing in commodities. I mean, think about it. If you buy a whole bunch of corn, you have to store it somewhere, right? You got to pay, because that's generally not free. So if you're buying corn, gasoline, gold, silver, crude oil, soybean, that stuff all has to be handled and stored. And there's an expense to that, and they're called carrying cost. Well, it's part of the carrying cost. There are a lot of costs associated with that. And since you don't typically take physical delivery of those products, none of the funds that invest in those things take physical delivery. They've got a futures contract associated with most of those categories: corn, soybean, cotton, the cocoa. Got all. There are probably about a couple dozen different types of commodities. Gold. Gold has to be stored someplace. That's not free. And somebody's got to make sure that it's insured. Insurance costs are in there. So I'm surprised that some of the interpretations by the Department of Labor are that you should probably carry some weight in that. They're not saying a lot, a little bit. And I'm going to use funds to do that. I'm not going to do it. I'm not going to go out and buy gold. I'm definitely not going to go out and buy corn or soybeans. So it's going to have to be in a fund. If you do not elect to have that in your portfolio, you just have to put it in writing. That's one of the things that I got from the most recent training I went to comply with the Department of Labor rules. I have an accreditation now. It's called an accredited investment fiduciary. AIF. You'll start to see that on my website, and you'll start to see that on my business cards. So accredited investment fiduciary. What does that mean? It means we've taken a pledge, a vow. They do a background check, make sure that you've never been in trouble, and you're always going to operate in the best interests of your clients, which is something that I elected to do in 2004 when I left and started this business. I didn't want to have a conflict of interest from a firm who might have their own agenda. By the way, all firms have their own agendas. All investment management firms in particular have their own agendas. And I didn't want to be influenced by that, so that's why one of the reasons I started to go out on my own and did launch my firm was so that I could invest in anything, anywhere on behalf of my clients. And my interests are perfectly aligned with my clients because if their asset values drop, my income goes down. Think about that for a second. Your asset values drop, my income drops. Asset values go up, I get a pay raise. Whose side do you think I'm on? It's that simple. I always thought the entire business should work that way, and now, when it comes to IRAs, and about 2/3 of the assets at Bullington Capital are in IRAs. When it comes to an IRA, they're under the same rules that these big pension plans are under. They just lumped them all in together. And it's a requirement, or going to be soon, a requirement that everybody take those same business methods, basically putting your client first, and you're supposed to operate under this new guidelines and these new sets of rules, which I think is great. And part of that is you're going to have to do an asset allocation, stocks, bonds, cash, what's right for you, and you're going to have to write it down. You're actually going to have to have a plan, business plan. They like to call them investment policies, and IPS, investment policy statement for short. And it's basically a summary of what you're going to try to do. So that's going to be a little bit different. And we, again, included in that are going to be commodities. So if you don't want to do commodity, you don't want to follow the models exactly, it's not that you have to. You just have to write down why you're not doing it. In commodities, if you look at in the super long run, when I say super long run, I'm talking back to the 1970s. Commodities would have been a great asset class to invest in during the 70s. Most of the returns that the commodities have earned over the past 40 plus years have been in the 70s. So I guess if you have a super long-term outlook, yeah, it makes a lot of sense. In fact, in the 1970s, a basket of commodities, you would have made more money than you ever thought possible. That's actually one of the things that Jimmy Rogers took advantage of. They were managing commodities-based funds, and I think their fund started in 1967. Him and George Soros were partners. And Soros is still around, a billionaire in his 80s now. But those guys were investing in commodities at the exact right time. That'd be like being a technology investor in the late 1990s. So those guys look like heroes too. Did come to an end, and the fund, I think it was called Quantum Fund. I can't remember for sure. Anyway, the fund that Jimmy Rogers helped George Soros run had a phenomenal track record because they were in the right asset class at the right time. There's always an element of luck to everybody's life. I'm sure, I've seen Jimmy Rogers. He's going to claim it was brilliance. And I'm going, oh, yeah? Well, then how come you haven't earned those returns since then? No, just kidding, kind of. Anyway, there's always an element of luck to everything. And including commodities in your portfolio is going to involve an element of luck. If you get really high inflation, and we're headed towards that at some point in time, Just don't know how long that can take. It can take another decade. It could take 20 years. I don't know. Might happen next year. You just don't know for sure. Doesn't look like we're headed there next year. Doesn't look like we're headed there anytime soon. But at some point in time, yeah, you're probably going to get higher than average inflation, and commodities will probably do well again. In the meantime, they haven't done very well for an extremely long time period, and the funds that are available in that category, I'm just not that impressed with. The carrying costs are way too high for the types of increases or price movements that you're getting, and the carrying costs that are involved. It's just not likely to be very profitable. So that's the issue that I have with it. Now, I know if you say, well, I'm just going to hold 5% of the portfolio there, which incidentally is typically one of the recommended allocations is just holding around 5% or so in the account. That's okay. 5% is not going to make or break a portfolio. If you got really high inflation, you'll be glad you had that 5%. If you don't get high inflation and it doesn't make much money, well, it's only 5%. And I think that's fine. That makes a good addition. Another inquiry I got, actually, this was from a client. I've been talking about a service we're going to provide and talked about contacting clients. We haven't started contacting any clients about it yet because it is a lot of work and it's not ready. So as soon as it's ready, I will begin to reach out. You'll get a blast email, and we're going to talk about setting up your own websites. You'll get an email inviting you to set up websites. So if you're a client, you're out there and you're listening, we haven't contacted anybody about it yet because it's taking a little bit longer than we thought it was going to, which is not surprising, by the way. But I think it's going to be a really good service. And by the end of next week, we should be 95%, if not 100% done and ready to send out those emails. And we're going to invite you to use the service, and I'm going to talk about it at the next seminar, which is what I really like to do when I can show something in person. I think that works out much better. It's a service that is basically, hang on one second, I just got another email. Nope, that's not an email. Sorry about that. We're going to be talking about it at the next seminar. It's a service I think is going to be very valuable going forward. It's going to be a financial dashboard. You can pull all your financial stuff in on one page. It has improved. We've tried to do this before, incidentally, several times. The technology just really wasn't that ready. It was the links kept breaking down to the financial institutions that you're trying to download information from. That was not fun. That has changed dramatically. And it's actually the company that is providing this. It's a company called eMoney. And Fidelity purchased eMoney. And Fidelity put a ton of dough into the development of the platform. So I think it's just about ready for prime time. And I think it's going to be very valuable going forward. And Fidelity, I really admire those guys a lot. They're one of the custodians that I use. They try to improve constantly. They really try to. And they're huge, a $5 trillion organization. And to have gotten that large, that is amazing. And it's because they come with their A game. They try. They don't, nobody always succeeds, by the way. Everybody has accidents and mistakes along the way. And if you want a really good example of what that's like, I think Jeff Bezos has a thing up on YouTube where he was talking about trying this new project. And he's just so open and blunt about it. Vast majority of people think you should sit down. Not the vast majority. A large percentage of people. Not the vast majority. I don't believe that's true. But some people think that you should be able to sit down and figure out every problem you're going to encounter before they ever occur. And you should have a plan that happens, that you have in place so that you can avoid those. Well, that's not unrealistic. That's totally unrealistic. Life just doesn't work that way. I'll give you a really good example. I've had several models, and a couple of my models right now, a couple of these stock models have been underperforming for about 2.5 years. About 2.5 years. Now, thank God one of them is in the top 10% of its asset class, the top 10% of its category. And the others are not low in their categories. It's that the category itself has not done well. Almost 3 years. 3 years is a long time. The average investor typically only holds a fund about 3 years. And so you go through an underperforming period like this, and a large number of people will abandon or jump ship. And so I'm starting to get some of those calls. And I'm looking at it. I'm investing in it. I still have it. Now, I do have an advantage because I still keep putting money into it every month. So my return's going to look a little bit better than somebody who was just sitting there and adding nothing to it. That's, dollar cost averaging does count, especially when you are in an asset class that's kind of volatile. And it's not just that particular strategy. I mean, it's everybody that's got a strategy that's even closely related to that. So that's how I know this is not something that's wrong with one of our models, when everybody in the industry is suffering the same thing. And by the way, when one category of funds has done better than all the others, you look into why that is, and I can tell you that it has to do with the size of the company and how they weight the funds. Market cap weighting has been the best performer over the past 4 to 5 years. Been the best performer over the past 4 to 5 years. It will not always stay that way. I can promise you that. I know it won't. Just like these are not always going to stay in the basement either. At some point in time. But it's tough. It is hard. Investing is hard. Don't let anybody kid you. It's not easy. No matter how much you hear, no matter how much you read on the internet, it's not an easy thing to do. It takes a lot of patience. Takes a lot of knowledge. Takes a lot of patience. And it's not fun. Believe me, it's not fun. And if you only had a crystal ball that works, you could always hold this style of investing that was going to be the best at that moment in time. Unfortunately, my crystal ball doesn't work. I do have a crystal ball, incidentally. I used to keep it on my desk, but I think it started scaring people, so I put it out in my lobby. It's still out there. But anyway, so you get an economy that's been growing as slowly as this one has. And slow growth, man. Below 3% for as long as it's been. Below 3% for as long as it's never happened before. So we'll talk a little bit more about that when we come back from these commercial messages. You're listening to Bill Bullington right here on 1420 The Answer. Stay tuned. And we're back. Hey, if you'd like to call 216-901-0945, 216-901-0945. And I was going to remind you of the upcoming seminar. This is actually going to be Saturday morning. We're going to be showcasing new technologies. That's what I was talking about a little bit earlier in today's show to help you stay on track with your investment and financial plans. It's going to be 8:30. It's a Tri-Cities Corporate College East. Great facility out there. It's going to be a lot of fun. We do these in the summertime so that I don't cut into your other activities. And by the way, that vacation fixation, man, I feel like I could use a vacation about every other week now. Just the sign of the times, I guess. But anyway, if you'd like to sign up for that workshop, I think this is what we've been talking about a little bit. We've been trying to get up to speed on this thing. Any new technology you have, especially one that's as comprehensive and as powerful as this one, takes some time. And it always takes more time than you thought it was going to somehow. And it just always seems to work out that way. But I really think that this is going to be a great service to add to what we're doing now, Bullington Capital. So you might want to come out and check that out. Stay on track on top of all your investments in one place. And by the way, there you can track your credit card accounts. You can track your mileage actually on your air travel, which is kind of cool. A lot of stuff. It's amazing. Technology is just it's mind-boggling, and it's part of what has actually changed the way that markets are behaving. Markets are always evolving. Incidentally, they're always evolving, and a lot of people think that stocks are more volatile today than they ever have been. And that's interesting. And in some ways, they're a little bit more volatile. Reality is, in the early 1900s, they were a lot more volatile than they are today. Like a lot. So, but they're more volatile today on a day-to-day basis than they have been ever. On a day-to-day basis, you've got a lot more smaller volatility. Smaller is like a 2% move up or down in the S&P 500. That's one of the smaller volatile days, or smaller volatility days, I should say. In the past, you've only had a handful of days that would be more than 2% in a day. In fact, I just read a statistic somewhere since 1940 or since after World War II. There have been more 2% days up or down in the S&P 500 since the year 2000 than there were in that entire time period since World War II. Think about that. Last 16 years, there have been more days where the market's been up or down 2% in one day than there have been since the end of World War II. That's what's changed. And I can tell you another thing that's changed. Correlations. I can tell you why they're changing. It's computerization. And, we're facing this. In fact, a lot of the models that, we were talking about a little bit earlier, the ones that have been lagging over the past 2 to 3 years, I'm not sure if that's permanent or not. You won't know that. You don't know that until after the fact. So I do have a plan. If you'd like to hear it, give me a call. You're a client out there listening, give me a call. We'll set up an appointment. I have a plan to, if this is going to be the way things are going to be in the future, then we probably want to reduce the exposure to those models and increase the exposure to other models. Now, I will never use a market cap weighted model, or I shouldn't say never. Very rarely will I use a market cap weighted model. What is market cap weighting? Market cap weighting is the S&P 500. That's how that index is built. The one that just hit a new all-time high, only up 0.37%, but newspapers like to go, hey, it's 0.37%, a third of a percent. That's almost as exciting as a CD. But they make a big deal out of it. The S&P 500 also has multiple 10-year and even a couple 20-year time periods where the return was negative. Think about that. Return was negative. Why? A large part of it is because of the way it's structured. It's market cap weighted. They put more money into Microsoft when it's $400 billion than they did when it was $4. That makes a lot of sense, right? Let's wait until it gets huge and then add a whole lot of money to it. And it's amazing that it's done as well as it has. Just amazing that it's done that well. But I get it. I understand. On the way up from $4 billion to $400 billion, they were adding more of it. As it got bigger, they added more to it. Now, see, here's the problem with that. At some point in time, that'll jump up and bite you. At some point in time, it's not going to be very profitable to do that. Look at go back to March of 2000. At some point in time, when companies have been added to just because their price has gone up, just because the price has gone up, that turns into a problem. It creates a bubble. Okay, so you go back to March of 2000. And a lot of people that are investing today don't know what that's like because they hadn't been born. That's amazing. They had been born. But if you're 35, you're only 17. You don't remember that. Okay. So the 1500. Okay, and it took it all the way until if you were reinvesting the dividends, you went for 11 years with nothing. If you were reinvesting the dividend, you put money in there and you just left it go. 11 years with nothing. And now the people that are still alive that were investing back then, they're still holding that fund, go, hey, it's at all-time new high. Great. As long as you got a 17-year life expectancy, no problem. I don't have a problem investing that way. But if you don't have 30 or 40 years, okay, then maybe you want to consider something like a fundamentally weighted. That means something like sales and profits have something to do with how they're going to pick the stocks rather than just who's the biggest. So that's my rant for the day on that subject. But by the way, the fund was that those funds were down 50% twice inside of one 10-year time period. 50% twice in one 10-year time period. Now, if you are fine with that, so am I. If you don't mind that, neither do I. Inevitably, 19 out of 20 people come in and say, hey, I know you can get the return without the risk, right? No way. It's just, in the past, maybe. And if you were going to do that, yes, I know there are ways, but they're not easy. None of the ways are easy. Will you be able to beat the returns? I think you can, but you got to be willing to put up with an awful lot of volatility. You're going to underperform the market from time to time, sometimes for 3 or several years in a row, which is what an awful lot of people are having difficulty doing right now, which I understand, because being human, being emotional, not doing this every day for a living, it's easy to get confused by that. Super simple. As a matter of fact, it's expected. It's one of the reasons people like me have a job, is to remind you, hey, that this is normal. That's not abnormal. And at some point in time, that'll turn around. In the meantime, when you're managing, when you're looking at models, when you're looking at investment performance, what you really want to consider is, what are they doing with the money? What are you doing with your money? What's that portfolio manager doing with the money? How is it being invested? The track record and the expense ratios are not the most important things, I promise you, because the S&P 500 funds has one of the lowest expense ratios. You can invest in that for next to nothing. Now, if you're okay with an 11-year negative time period, like I said, so am I. It's up to you. And inevitably, people go, well, I can get you out before that and get you back. No, you can't. You won't. Try that and see what happens. In 15 years from now, or at some other point in time when, and by the way, that's not the first time the market's had, the S&P 500 has had those problems. And it's happened many times during the history. And now my charts are not going back that far, which is really upsetting me. But anyway, if you look back at the late 1960s to the early 1980s, the Dow, which is another popular index, it was actually flat over that entire time period. That is an unbelievably long time period. The S&P 500 had a 12-year period during that period, negative. So that's market cap weighting. And if you really want to get out there, during my next commercial break, I'm going to look up the Nikkei, because the Nikkei is probably the most famous market cap weighted index in the world. In the 80s, when it looked like Japan was going to own the world, and a lot of you guys are too young to remember that, especially anybody listening to the show today, but a lot of the older people, my age or older, if you're over the age of 50, you probably remember that. 1980s, Japan was buying everything. They're coming over to America. They're building these big factories, hiring all these workers, and they're going to own the world, just like Saudi Arabia was back in the 1970s with the oil. Yeah, I remember that one too. Yeah. So a lot of you guys probably not even born during that time period. You wouldn't be expected to remember that, but you should have looked it up in history, but only if you want to be successful financially. Only if you want to be successful financially. If you don't want to be successful financially, pay no attention to history whatsoever. Go out there, wing it, guess, make your choices filled with emotions. That's not a good way. That is not a good way. So one of the things I like doing on the show is bring some of that up. I studied the stock market all the way back to the 1800s. And you know what? During the 1830s, 1840s, there were publicly traded companies that were involved in railroads. Railroads were the internet of its day. They were the internet. They created these big, well, actually, they're not that big now. If you actually go look at one of the trains, they were relatively small back then, but it was big for their day. And they were able to take stuff. People were able to put stuff, corn, cotton, someplace in Georgia, get it all the way to the coastline, send it over to Europe. Did you know that during the Civil War, Europe had become so reliant on the cotton exports from the United States that some people were planting cotton in their backyards and selling it in Europe? Well, if you could have bought cotton futures in Europe back in the 1850s, it'd have made a fortune. 1830s, 1840s, 50s, 60s, all the way up until the early 1900s, railroads were growing so fast. There were so many of them, and they were paying so huge amounts of dividends At one point in time, some of the railroad companies during the mid-1800s were paying a 20% annual dividend. Think about that for a second. 20% annual dividend. And the share prices were crazy, and a lot of the companies that had bad luck or just were managed poorly ended up going away, ended up filing for bankruptcy, and they were driving each other out of business by the early 1900s. And J.P. Morgan Chase, I don't know if they still do that, but the J.P. Morgan and Company was set up to run a trust to make sure these guys would operate and cooperate and not overlap and overbuild, because there's been so many booms and busts during that time period that the United States government stepped in, created a trust that these guys they managed the entire railway system, which was the system. There were no highways back then. It was the transportation system in the United States. That's an incredibly important thing to do. And think about that. So they put them in charge of that trust that regulated the railroads. And that's about all I know about that, other than they got a fee for doing that as well. It's one of the reasons they're so big now. And by the way, J.P. Morgan and Company cashed the checks of the Union soldiers when the United States government didn't have enough money to cash those checks. They made them a loan and cashed the checks. And they only charged them a 2% commission, which I thought was kind of cool, because they charge you $3 at an ATM now out of 100. $3 out of $50, that's 6%. $3 out of $25, that's crazy. Okay. Yeah. Anyway, so there's nothing really new, I guess is what I'm trying to say. It just repeats itself over and over in slightly different fashion. Slightly different fashion. So if you know some of that stuff, it can really help you as an investor. It can help you. When you're feeling bad, you're down because you're underperforming, just know that that is normal. Almost every portfolio manager, in fact, every portfolio manager that's still alive, that's had a better long-term track record than the stock market, has had at least 3 or 4 years where they've underperformed. So, and it's always hard to know, by the way, if what they were doing is just not going to work, or if it's gone away, or if it's just one of those lulls in their performance. Don't know. You just have no idea of knowing that until at some point in time it will become completely obvious. And I don't know. I'm not seeing any signs that it's completely obvious yet. I mean, one of the things that's been happening over the past few years, you've had the longest period of sub 3% GDP growth ever recorded. Since they started recording economic statistics, that happened just recently. And that is highly unusual. In fact, way back when I was in college, they taught that the market cycles were only 36 months. That was it. 3 years. So why have we had 8 years back-to-back sub 3% GDP growth? What happened? I don't know. I know what happened. It's overregulation. That's probably the biggest problem. Lack of decisiveness. Being too indecisive, taking too long to make decisions. That's why we got such a big change in the government. People, if you go left or go right, but you got to go. You got to make up your mind, and you got to start moving in that direction. You can correct along the way, just like your portfolios. That's the way you should be running the portfolios. So anyway, we're going to have to be having conversations here shortly with the many clients. Again, I haven't reached out yet because I thought this would be done by now. It's not. It's probably going to be a week at least. So pay attention, because you will get you're going to get an email, and we're going to have to talk about it. I can't talk to all of them at once. So basically in alphabetical order, going down the list. And it's, something new. There's been some other changes that have been going on in the marketplace. Again, the past 5 years, almost every fund that's open has had some scheme, some form of market cap weighting, which has really produced outsized returns for that category. It's outperformed by the largest amount that it ever has since I've been tracking the market. And that's kind of interesting. Let's put more money in Microsoft at $400 billion than we do at $4 billion. And that's been working very well. And it will until it doesn't. Okay, so trying to prepare for that. A lot of stocks have not participated in these moves over the past 3 years, and a lot of people are upset by that. And, well, why haven't I made any money? The same thing that happened in the late 90s, 95 through 2000. Again, market cap weighting. let's buy more of what's just gone up the most. And for 5 years, that outperformance blistered the other investment strategies. I'll tell you what those other strategies were that came back right after these commercial messages. And we're back. Welcome back. Oh, man, I do this all the time. Got back here and I lost my whole train of thought. Get on the commercials. I start listening to the commercials, and next thing you know, we're back on the air. Anyway, if you have a question, call or comment, 216-901-0945, 216-901-0945. And feel free to email with questions as well. Not a problem. Try to get back to you as quickly as possible. And I was talking a little bit about the upcoming seminar earlier. I do remember that. And we're going to be showcasing some technologies to help you stay on track with your investments and your financial plans in general. And I think it's pretty exciting. I like the technology. I've seen others out there, and like I said, I've tried this multiple times before. It just really wasn't that ready. I don't know if you've ever tried like Mint, online tracking your spending. That was a little difficult. The links to your financial institutions kept breaking, and there are other programs fairly similar to that. You got a lot of robo-brokers out there that are trying to do something similar to this, and I really think that this product, it's called eMoney, I think they got it down pretty good, and it's going to undergo constant changes now because Fidelity bought them, and Fidelity likes to continuously improve wherever they can. And like I said, there's not a single solitary piece of software out there that doesn't have at least one bug in it, as far as I know. And you're hoping you're not going to run into that. We've already run into a lot of things. I'm so tired of hearing the phrase, wow, that's never happened before. You talk to a tech support person at some software company. If that were true, if I had a nickel for every time somebody said that to me, wouldn't be working. Anyway, feel free to contact me too on the website. I think the Department of Labor rules now are kicking into force, and it's going to be applied everywhere. We've always had to use the philosophies now that they're requiring in IRAs and retirement accounts. They're requiring that people do what we've been doing for the past 12 years. Yeah, actually 13 years. And that's basically try to put your client's interests first. We're working on the same side of the table. You're not coming into it with an agenda, a high commission product. You're basically hiring people as consultants. And I think that's the way that the whole business should have run from the very beginning. But, at least a big part of it's going to be that way now. And I think overall it's going to be a good thing. And with the way that the markets have been evolving, I think that even the diversification portion of it is going to be a good thing. Suggesting these other asset classes, I think is going to be a good thing. And that is still not very clear. They haven't put out government-approved models yet, although Morningstar does have a few of them that I know will pass the government's rules. And if not, they'll just change them anyway. But the bottom line is we'll talk a little bit more about that after this phone call. And I've got Rick, you have a call or question for me?
Yeah, Bill, I was reading an article the other day about the S&P 500,
mm-hmm.
and it says 10 stocks in the S&P 500 account for almost half of the S&P's gains for the year.
Yes.
And those stocks being Facebook, Amazon, Apple, Netflix, Google, Philip Morris, Oracle, Home Depot, and Broadcom.
Right.
So given that, there just hasn't been a lot of participation.
No.
On the part of some of the other stocks, and it just seems to me that the stock market, at least in these particular securities, are way overvalued. Just wanted to get your thoughts.
Some of them are. A few of them are, which gives me actually hope because some of them aren't. Some of them are generating a tremendous amount of cash, even relative to the share prices they're currently selling for. They're getting a little bit more expensive. And some of them, Facebook is expensive. I don't care how you look at it. That's an expensive stock. Now, I know a lot of people are going to argue with me over that. And they're saying, yeah, but it's growing and it's had its best quarter ever. Okay, Now, the same thing you said about Microsoft, Intel, and Cisco Systems right before they lost 75% of their value. So, whatever. I'm not a big fan of that, and the reason that those stocks have gone up so much is because a market cap weighting scheme requires that as the share price goes up, that they add money to those stocks after the fact. So it's a self-fulfilling prophecy. And by the way, that has dominated the financial markets for the past 5 years. Very similar to the way that it did in the late 90s. The big difference is they're not nearly as overvalued as they were back then. The good news is that means a lot of companies, good companies, have not participated. So I built a model, by the way, to try to take advantage of that. Again, no guarantees that you can do that. But I took the operating income from all the companies from the S&P. Well, actually, I just took the top 1,500 by size, by market cap, and said, all right, I want the 50. Actually, I have 3 models. There's a 30 stock model, a 50 stock model, and a 100 stock model. I want the 30, 50, or 100 stocks. You'd elect to use one of those models depending on how aggressive you want it to be. The 30 is the most aggressive. The 100 is the lesser aggressiveness of the 3. But I want the stocks that have the highest amount of cash or operating income over the past 12 months relative to the cost of the business. Now, that's kind of how Warren Buffett looks at these things. If I buy this business, I buy the whole thing, how much am I going to get? That's what I'm asking. That's the question I'm asking. So these are the companies whose valuations are lower, who are cash flow positive. That's always a good thing. And are selling at the lowest prices relative to those amounts of cash that they're generating. If you look back in the long run, having done that, and these are just hypothetical illustrations I built with my Bloomberg terminal, that's a really good strategy. It's had at least in the past, it has been on the computer simulation. And it makes common sense to me. It makes a lot more sense than let's add more to Microsoft or Amazon just because it's gone up in price. To me, that's if I had no other choice, I guess I would invest that way. But I wouldn't have a large percentage of my money in the stock market that way. It's just too volatile.
Mm-hmm. Yeah, I look at companies like Netflix and Twitter.
Yep.
Neither of these companies have ever turned a profit, yet they're selling at these obscene prices. The valuation of the company is just harkens back to the year 2008.
Yeah.
That's what kind of worries me.
Yeah, the valuations are actually more similar to 2000, I think. And I'm going to look Netflix up because I haven't looked at that one in a long time. Yeah, Netflix has $9.5 billion in revenue, and their market cap, that's the value just a stock, is $71 billion. So yeah, that's pretty healthy. But Microsoft, by the way, they're talking about right about 8 times revenue. Microsoft in the year 2000 sold for 24 times their sales, not their profit, their sales.
Wow.
That is crazy. That's why it took it 15 years to recover when it went down.
At least they were making money.
Oh, yeah, they were making money. Netflix does have a profit margin. It's actually pretty good. And their growth is still pretty quick. But, like you said, that stock's overpriced. Now watch it go up and double from here because we just talked about it.
Yeah, I guess the fundamentals don't matter anymore.
Well, fundamentals rarely matter. Actually, that's if they did, nothing would ever get underpriced. Nothing would ever get overpriced. They would be right exactly where they're supposed to be all the time. And all that efficient market theory, it would work. It wouldn't be a theory. It'd be a law. But it doesn't. People get excited. They get, you do these computer models with regression analysis that you can justify just about anything. So it's tough. What's killing me is the small cap, large cap, mid cap, all the strategies. The market cap weighting has been the dominant strategy for the past 5 years, and it's long enough now to convince people that they should just keep doing that. Hang on, wow, this is so reminiscent of the late 90s. It's mind-boggling.
Yeah, okay. All right, well, very good, Bill. Thank you very much.
Hey, thanks for calling. Yep. Bye. And if you have a call, I think we have a only a couple minutes left here, 216-901-0945. And I know a lot of this probably goes beyond what most people want to know about the market. They just want to know how to make money. And see, there's a problem with that. You have to know a little bit about stocks and how they're valued. And over the next few months, I want to try to bring a lot of this down to the level that a fifth grader could understand, because that's about the time that you surely should be starting to think about this. Right when you're around 12 years old, 11, 12 years old, you know enough math at that point. You've probably already done percentages. If not, you're about to. And you can understand the basics. When you look at a company like, in fact, I got to take, since we talked about it, I'm going to take Netflix. And the enterprise value of Netflix is $73 billion. That's what it would cost you to buy the entire business at its current price. Okay. So you can look up the academic version of that definition, and you'll notice that mine's a lot easier. It's basically the cost of buying the entire business. So you'd pay $73 billion. Oh, I only have 60 seconds left. No, okay, somebody hung up. You can call me in the office if you have a question or email me. So $73 billion. Now, they had $9.5 billion in revenue over the past 12 months. $9.5 billion in revenue over the past 12 months. Their profits after taxes were $337 million. Now, $377 million sounds like a lot of money until you realize that somebody's paying $73 billion, and 5% of $73 billion would be about $3.5 billion, or 10 times the amount of profit they've had. That's what the guy meant by it's extremely expensive. Yeah, it is. It's expensive. So I would probably, all other things being equal, I would probably avoid Netflix at this point, unless you're going to be a trader, which I didn't get to talk about today because I talked about other things too much. Anyway, this is Bill Bullington. I'm here every Saturday morning from 11 to noon on 1420 The Answer. Have a good weekend, everybody. Good luck and good investing.
You just caught another episode of the Bullington Capital Report, broadcasting every Saturday morning at 11 a.m. on AM 1420 The Answer. If you have a question and would like to speak to Bill personally, you can call him at 330-664-0700. That's 330-664-0700. Or contact him through his website, bullingtoncapital.com. That's bullingtoncapital.com.
Past performance may not be indicative of future results. Therefore, no current or prospective client should assume that the future performance of any specific investment strategy, including the investments and or investment strategies recommended and or purchased by advisor, or product made reference to directly or indirectly, will be profitable. Different types of investment involve varying degrees of risk, and there can be no assurance that any specific investment will either be suitable or profitable for a client's investment portfolio. No client or prospective client should assume that any information presented serves as the receipt of or substitute for personalized investment advice from the advisor or any other investment professional.
The preceding program has been paid for by Bullington Capital Management, LLC.
The preceding program's views, claims, or representations may not reflect those of AM 1420 The Answer or Salem Media Group.